Maybe it's just in the wrong setting.
There it goes.
Okay, I'm going to relaunch this. Give me a sec. Let's see if it works. Where's the mouse? Mouse is gone.
I don't think you should relaunch it. I think you're good. Yeah, you're good. Just let it go.
I'm going to delete it because I don't want to have one that's... We'll just cut the intro out, I guess. Not a big deal.
No, that's fine.
Okay, the audio is good. People said it's good, so we don't even need to relaunch. We're good.
Nope.
Okay. Hi, everyone. Sorry about that. We had no audio. The audio is actually taped to my chest right now. We have a little microphone taped inside my shirt, which is kind of cool, and it's picking it up. So, loving the new audio device. Austin, I see you on your... Good. Mike says audio is good. Okay. So, yes, welcome to the Mike Rosehart Show, where we talk about personal finance, financial independence, and real estate investing. You guys bring your questions, and I'll answer them live. I'll tell you what's been up in my life, and then that's all. That's the show. We're live on the new channel, not the old channel. Some of these comments and some of the highlights we put into YouTube videos that will be used later on, potentially. I'm thinking about going back to my daily video journals on either YouTube or Facebook. I'm not sure yet. I was thinking about using this YouTube channel to do a daily, 2-minute vlog of what's up in my life and just share that, almost like this second YouTube channel is like a Patreon for you guys, and it's free, and sort of sharing what's up in my life. Am I a bodybuilder yet? Yeah, I'm in the gym pretty hard, so I've been trying. No, I'm not a bodybuilder. My sole goal is just to go to the gym 3 days a week. I want to do a series on how to be frugal with getting fit. So fit and frugal, where I do at-home workouts using chairs, a couple of dumbbells I got for free on Facebook Marketplace, and calisthenic type workouts, using your body weight. So I use a lot of that kind of stuff to get really fit, and I'm in really great shape without having to go to the gym. No gym membership, without having to do all those things that a lot of people do, right, to get super, super fit. So I'd do a segment on that. But anyway, this channel, want to use for different than the main channel. The main channel will be very polished videos. This Saturday's video is going to be interesting. I think we're going to either do the one on minimum wage, but we may do the one on the socialism one. I have this video that's about a professor, or I read a script about a professor I tell a story about a professor who is an economics professor and proves that socialism basically doesn't work. And then I share some of my views about why I think socialism and communism don't work. Same right, I think pure capitalism doesn't really work either. There's sort of a middle ground that's great. So that's going to be an interesting video that I drop. That'll be out of left field and kind of just branching out into the political sphere. But I was curious to see how that would do on the main channel. It might do terribly, and I might shy away from it, but I got a minimum wage video coming up. It's going to be really cool about how to be a millionaire on minimum wage, how you can live well on minimum wage. Some really good videos on that, which I think will do really well, given there's a current opportunity in the market for content like that. Yeah, Facebook Marketplace, so much stuff you don't need. Yes, but you can get tons of stuff there for free. Be surprised. We've gotten baby clothes on there for free. People just want to get rid of stuff. Same with Kijiji, they just want to get rid of things. And when you need that certain thing, I felt I needed some dumbbells so I could do the shoulder press exercise. And, if you can get those for free, that's awesome. Why? Some people spend hundreds of dollars, thousands, tens of thousands of dollars on these Bowflex machines that they never use. And it's just the whole health and fitness industry is just filled with people spending way too much money and then not putting in the work anyway and not getting the results. So I should talk about that because it's a piece. Eric, how you doing? Hey, Mike, go Raps, go. I'm not a big Raptors fan, but I've been watching the excitement through all my friends. Jordan says, good afternoon. What are some of the tactics to turn around a really bad multi-unit building? That's a good one. Multi-unit, this could almost be a good little rant I could go on here. Yes, so multi-unit apartment investing. Well, hey everyone, this could be good. I actually should just do it right now. I should just do a video on multi-family apartment investing. You guys want to see that live? You want to see behind the scenes? That's what I was supposed to use this Mike Rosehart Show for, is to literally just go live and do a video. I don't do a lot of videos on multifamily investing. I don't know how it would do, but let's do it. Do we talk about a big building, or a medium-sized building. Let's pick like a sixplex, because with RBC you can have residential financing. With some consider it commercial, but depends which lender you talk to. Like RBC and Desjardins will use it as a residential mortgage, so consider that residential multifamily investing. Okay, so hey everyone, welcome back to the channel. We're talking about multifamily apartment investing. We are live right now on YouTube. Someone just asked the question. They said, good afternoon, what are some tactics to turn around a really bad multifamily unit? So how do you invest in multifamily? We're talking about lots of units. I'm talking triplex, fourplex, fiveplex, sixplex, sevenplex, 10plex, 12plex, 20 unit building. How do you turn something like that around? How do you make money in multifamily real estate investing? It's a different ballgame than the single family, renting to a family, than even the student rental game, than the Airbnb play, than, even like duplex type of property, because the way that you appraise multifamily property is entirely different than the way that you appraise low, like 1 or 2 units, like smaller residential type deals. Because of that fundamental difference in how they appraise the property, how value is derived. Yeah, a sec. Lips itchy there. Because of that difference of how the value is derived, I forgot what I was going to say. Oh, that you have to have a different strategy and a different approach. So because the values are different, that you come to residential real estate versus, multifamily apartment building investing, you have to have a different approach. So with multifamily, net operating income, or NOI, is how you determine value. So they will trade at a cap rate. A cap rate is basically the net operating income relative to the price of the building. What that means is the more rental income you get on a multifamily building, the more it's worth. With residential real estate, that's not always the case. They like to use comparable approach. So they will take, if the neighbor's house sold for $100,000 more, this duplex is worth $100,000 more because it is worth what the market is willing to pay. In multifamily, if you can get the expenses down, let's say you could put in coin-operated laundry and generate an extra $1,000 a month, which is like in a big building, that's totally possible. In like a 12plex or even a 15, 20 unit building, you can get $1,000 a month from a good, well-operated laundry addition, right? You just put in like a little laundry room where there was a storage room before. It's a small little thing you can do to add value in multifamily. And that's huge right there. You do one little thing like that, or maybe you replace the whole building from, inefficient incandescent light bulbs to LED light bulbs that are super efficient, that use 1/10 of the hydro cost. If that saves you $500 a month on hydro cost, over the year that's $6,000 onto your NOI, added to your net operating income, because your net operating income is derived by all rental income, all sources of income from laundry, mostly rental income, but also laundry income and parking income, and you can rent out storage lockers and things like that. So that'll be your income side, and then your revenue side, all your rents and things coming in, and then you'll have your expenses, which is like your hydro, your utilities, all of those things that basically you have to pay to keep the building going. So like your utilities, your property taxes, maybe any fees to the city, if you have like gas bills and water bills and all of the other miscellaneous property management bills and etc. PMIT is basically what I use. So P is property taxes, M is maintenance, I is insurance, and T is taxes. So did I get that right? I think I'm missing something. But whatever. You basically got an income statement is effectively how you get your net operating income. So if you can decrease your expenses and increase your income, you add value to a multifamily right away. The biggest way to add value to a multifamily building is to increase the rent roll, to increase the rents. So you have to turn tenants over, fix the units up. Sometimes you don't even have to fix the units up. Sometimes it's as simple as literally getting an old tenant out who is paying half of market rent and then putting in a new tenant at market or slightly above market rents. Doing that one thing. I know someone who did that with a 12-unit building. They literally went in and said, hey, here's $1,000 a tenant until $1,000 per tenant that leaves, and I'm only going to offer it to the first 6 people that take it. And people jumped on board to get on that, and 6 people were gone right away. They created that like fear. And then for $6,000, they had those units vacant and were able to go right from there to putting in 6 new tenants at top market rent. They increased the building's value by $200,000. So a $6,000 investment into evicting low rent tenants, under market rent tenants, created $200,000 in upside equity. That's the beauty about I think multifamily investing that makes it so attractive to investors is that the numbers don't lie. Like you literally just increase the rent and decrease the expenses and create a stabilized accounting record of that and show that to another investor, show that to an appraiser, and you've increased value. With residential real estate, it's a little bit trickier. They will sometimes use the net income, operating income approach to valuing property, but they mostly rely on the comparable analysis approach. And they rarely ever use the cost-based approach. So what did it cost to build the property? Mostly they use comparable analysis. In multifamily, they use the net operating income as their primary driver. They use cap rate. What is the market willing to pay for cash? Bring an appraiser through that you hire independently. And by the way, in residential, the bank hires the appraiser. In commercial multifamily, you get to hire the appraiser. You pick the appraiser. So you could call an appraiser and say, hey, I'm buying this building. I'm going to call you in a year to refinance this building. Can you walk through it with me and tell me what I would need to do to get a value of X? I'm buying this building for $800,000. What would I need to do to get $1 million appraisal? And the appraiser will walk through and say, hey, pick these 4 units, turn them over, clean them up, give me 4 clean units that I can take pictures of and get the rent roll up to X, get the expenses down to whatever. They'll give you some strategies. And for a good $1,000 or $2,000, you can have a plan of attack to guarantee you a couple $100,000 in multifamily. The value add opportunity is very clear in multifamily. Now, there are some drawbacks to multifamily investing. There are some pros, right? I personally think that the property tax rate, mill rate, like the rate at which you pay property tax per dollar of building in multifamily is too high. Specifically in London, it is ridiculous. Like $1 million 12-plex and $1 million duplex, right? Both $1 million. $1 million duplex will have property taxes of like $6,000 a year. The $1 million multifamily building will have like an $18,000 a year property tax bill. So dollar for dollar, the expenses are way higher in multifamily because insurance rates are way higher, property tax rates are way higher, and you have to put a lot more down on multifamily unless you go through CMHC financing on the multifamily side, which you can do. You can use CMHC apartment building financing to buy 15% down on apartment buildings. You can buy $1 million building for $150,000 down or 15% down with CMHC commercial financing. Not all buildings qualify, and there's a lot of different qualifiers we could talk about in another video, but there are some distinct disadvantages. Like most lenders want 65% loan to value on large multifamily, whereas they're okay going 80% loan to value without any mortgage insurance on residential. So you typically get a better leverage ratio on the smaller residential stuff, which is why I focus on that so much. I like the large duplexes with like 10 or 20 bedrooms, like the big, massive duplexes and triplexes. I love those, and fourplexes because I get residential financing. So commercial financing, typically you're looking at like an extra percentage point higher. So we're all got a 2.99 5-year fixed on my residential property mortgage. I might pay 4% on my commercial property mortgage. So you have higher, like I said, insurance costs, higher property taxes, typically a little bit higher fees from the city, and often you'll have higher interest rates from your bank. So you'll have a little bit higher expenses, but the value add formula is much clearer on the multifamily side. You simply have to increase your rent roll or your income by adding things like laundry or storage units or trying to charge for parking spaces or just getting the rent roll overall up, right? Getting the rents up. Or simply just decreasing the expenses, ideally doing both. And as soon as you increase the net operating income, you can sell that building off to an investor who is likely more of an institutionalized investor. For some reason, and I won't get into it here, but most of the accredited investors and the institutional wealth, most of that type of money doesn't want, like the big REITs and all that kind of stuff, they don't want to buy small rinky-dinky 200,000, 300,000 deals. They don't want single-family duplexes. They want to buy $1 million buildings. So what you find is these people, a lot of these large funds will get guys like Sun Life or like a big insurance company to back them with millions of dollars at like prime minus 1% and tell them to go park it in safe real estate. And they deem large multifamily as safe real estate, whereas they seem like the residential duplex, triplex as not as safe. So what I've found is in the large multifamily space, there's a lot of institutional competition. What that means is they're willing to pay more for the income. They're okay with a 6% cap rate, right? A 6 cap rate or a 6% overall return on their cash. They're okay with that lower hurdle rate is what I found in most cases. So there are opportunities in the multifamily space. I love multifamily. You need to have big kahunas. You need to have a lot of money to make money in multifamily. But the plays you can make in multifamily can be huge. And you have to do a lot less deals to make the same amount of money. I've had to do 50 smaller, 500,000 and smaller sized deals to make the same money that I could have made doing 7 big multifamily deals. So eventually it gets to a point when I'm working with, say, 50 or $100 million in capital, I can't deploy that into small residential deals. And so you eventually have to move on to the bigger stuff. And that's just the nature of investing. I think most investors shouldn't start with large multifamily. I think the place to start is your small single family, duplex, triplex, your smaller stuff. Max out your personal residential financing, right? And then the big distinction is with multifamily, the personal investor doesn't always qualify. The building qualifies itself. So oftentimes these big 20-unit buildings, you get the financing based on the building itself, right? You bring that financials of the building to the bank. Whereas you're buying a duplex, they're looking at your personal income. Can you personally service this property more than can the property service itself? So just a slightly different financing approval process. And that's sort of that financial incentive, I think, to buy on the large side, it just makes it easier. I guess there's like an incentive. It's just easier to do, to buy the big multifamily as an investor that's tapped out on the personal residential side. So there's tons of nuances, tons of differences. That was just a quick video. I don't know if we'll use this clip, but I figured I'd just look at the camera the whole time. And now I'm going to go back to the questions for the people that are watching. Was there no audio that whole time?
No.
Okay.
No, there was.
Does the camera have audio?
I've got this as a background. But that's for the backup for the video later. But yeah, the audio's.
Did anyone hear any of that?
Yep.
Okay.
Yep.
Good. As long as people heard
quick.
that.
I was trying to mess with it, and I was like, "What's going on here?" Because I could only hear it at one point.
So hopefully that answered your question. Okay, just a few seconds. Cool. So hopefully that helped you understand multifamily investing. I kind of made that as like more of a clip that I can use for later. But I specifically was just answering your question. Did I miss anything? Let me go back to review the question. So how do you turn around a really rough building? I think that'd be the last part of it. So you can buy, within the multifamily segment, there are several different types of buildings that you can buy. And this may be even part of that clip I just did. But so within that segment, there's a lot of different types of buildings that you can buy. And there's like the turnkey, super well-maintained, renovated, all A-level tenant multifamily building. And there's that derelict D-tenant multifamily building, that 20-unit building that's been like beat up for 15 years. The landlord never is present. The property managers that live, the in-unit live-in manager, they're terrible. That's the nice thing about a large multifamily building too, is you can put in a live-in property manager. That's really nice. Having that superintendent living there on site can alleviate a lot of your burdens. And having more units in one place tends to be more efficient. I haven't always found that. I found that having a bunch of houses on the same street is more efficient than one building, but in theory, you would have, one furnace being a lot cheaper than 5 furnaces for 5 houses, right? What I found is typically that one furnace is like $35,000 to that boiler system in a commercial building, and I got a HVAC guy who will pop in a furnace for $1,900. So I can do 5 furnaces for like under $10K. So it just depends on, I guess, on the residential side, I've been good at getting really good deals. It's hard to get those deals on the commercial side. No one's going to come in and do your roof for like half price, right? Where you get those fly-by-night guys who will do a roof on a small house for cheap. So I don't know. It kind of hit or miss, but in theory, you have economies of scale, which means that you have everything under one roof, one boiler system. It's supposed to be more efficient to have all of these things compressed. You have basically what they call economies of scale. So you divide the cost over multiple units, and it is cheaper per unit. Should be cheaper per unit to have large multifamily. And how you turn around like a C-class building that's had rough tenants in it, it's a challenge. I'm not going to pretend that it's easy. The property manager that takes that on, or if you're going to do it yourself and manage it yourself, the guy who takes that on, that's a big task. Evicting tenants is one of the hardest things to do in the property management business. Trust me, I do it. It's hard, especially ones that don't pay rent, especially when they have kids and families. It's an emotional roller coaster. And I think turning around the actual renovating of the building is really easy to me. I bring a crew in, we could turn it around. It's getting the tenants out to do that work that's so hard, in my opinion. Sometimes it's simple. Sometimes it's just putting on a new roof, repaving the parking lot, and negotiating with the tenants to raise rent. You can even go in, and if the tenant consents, you could raise the rent above guidelines. You could say, hey, I'm going to put in a new kitchen for you, but I need $300 more a month in rent. And some tenants will just agree to that, right? They're like, okay, cool. I would love a new kitchen. That's worth it to me. And then you're cool. You don't even have to evict the tenant. You just come up with a win-win solution. So you turn around these buildings, you got to go in and say, okay, so how do you turn it around? Often these C and D class buildings, they have terrible utility usage. There's water leaks, and so the water bills are really high. Nothing's efficient in the building at all. And because of that, really high expenses, likely low rent roll, because no one wants to live in a bad building with other bad tenants. If you got a bad drug dealing tenant, that tenant acts as an anchor for other bad tenants, and in fact deters the A and the B tenants. They don't want to live in the same building as someone like that who's bringing that type of traffic. So you may have to, usually with a bad building, the first thing you do is you find the 2 bad apples and you get rid of them. You may have to go through like N5. N5 is like, if they're selling drugs or disturbing the peace with loud music, you may have to evict them at the landlord tenant board. That's a whole process in and of itself, but there are channels for that. And so in a really bad building, like you said, there's a lot of opportunity for the hustler to get in there and make some real money by making some management changes to the building. And then in a year, you've stabilized everything, you've turned it around. Maybe you just got all B tenants in there now, and you don't have those bad apples in there. Now your building might be worth $200,000-$300,000 more. Because remember, people will pay more for the income that you have, even if the income hasn't changed, if they feel safer about it, if there's a lower risk level to that return. So what you can get is a better cap rate on the same income, even if you change none of the income, even if you change none of the expenses, but you made the building feel safer. You made an institutional investor who walked through it the first time and saw the drug dealer out front, handing dime bags out. You made them feel comfortable this time, and now they're willing to spend $1 million, whereas before they weren't even willing to spend $800,000 because they didn't feel comfortable in that investment. It didn't feel like a safe place to park their money, and that's the big thing. When you're turning around a multifamily building that's not desirable to an investor and making it desirable to that investor, it really is about creating comfort and bringing the net operating income up. So it's bringing the income up, bringing the expenses down, and then overall making it a good package to bring to another investor. Because you got to think your exit strategy always. Maybe you want to hold this building forever, but eventually you're going to want to sell. And I think even if you want to hold it forever, you should always have a plan B. All of my properties, I'm like, I want to hold them for a long time, but not all of them. Some of them I want to get rid of, but I always go in with the mindset that even if I want to hold this building forever, I have an exit opportunity. Can I sell it for more than I bought it for? And that's the thing that I am always looking at. Like, did I buy this for a good 80 cents on the dollar? That'll give you a level of comfort. And maybe you bought it at market value for what it is, but there's 20 cents on the dollar of upside just by making a few strategic changes to that building. So on the multifamily side, there's a lot of big plays you can make. For instance, like putting in a few hundred hours of work into a large multifamily building. If you make 20% on $1 million, that's $200,000. You make 20% on the same amount of effort put into a triplex property. If it's a $300,000 or $400,000 property, 20% on $400,000 is $80,000 profit. So if you put that same amount of effort into a big building, you'll likely get a better return on time, return on effort for your money. So you might make $200,000 instead of $80,000. You just have to do more small deals to get the same impact as the large deals. And I'm very pro-residential because you get such cheap financing and all the things I said before, but that's my thought. Great question. Thank you for stimulating that question, because I think this is actually a good video for the main channel, and I'll probably actually use this video for the main channel. Hopefully the audio is still on. This mouse is dead. I don't even know how to turn it back on. There we go. It's alive again.
There you go. Maybe just check the.
The left ear is loud for some reason.
Check your thingy. The other end.
Oh. Less loud? I've set it on the table. Look at this little transmitter. Isn't that super cute, guys? And look.
Demonetized.
This channel's demonetized anyway. I don't have 1,000 subs or enough watch time, so nothing to lose. Nothing to lose.
You have nothing to lose.
This is why we go on the other channel now.
Ready to go, yeah. That part can't go on the other channel.
Austin just asked a great question. This would also be a good one. This could even tag onto that same multifamily video. It would be a great little Facebook clip or Instagram clip if I ever got around to doing that, or if Kyle ever got around to doing that. Either of us got around to ever making this into a little clip. Austin asks, what's the max you'll pay cash for keys for a really stubborn tenant or a tough tenant? Like, how much? The cash for keys strategy is basically you pay them to leave the unit. So how much do you have to pay a tenant to leave? And when is paying them too much? And how do you know, how do you handle that cash for keys strategy? And how do you pay? What do? You bring them cash. And if it depends on the tenant. There's a lot of strategies that work. I find that with the D tenant, you go there with cash to get the form signed. And they need to sign the forms, like the N9 and the N11. N9 is them giving you notice that they want to leave. N11 is you guys agreeing together mutually they're going to release it. N11s have been thrown out in court sometimes. N9s always work. So I get the N9 and the N11 signed, and you're all good. Here in Ontario, that's the way to go about doing it. This is a very niche Ontario-specific rule, but if they sign that, you can go take those papers and file them with the board for the time that they said, and they will be evicted. Like that, they've already agreed to leave, and so they can't just change their mind. And you might even bring a third piece of paper that says, hey, I've agreed to give you X amount of dollars in cash right now, and you've agreed to leave. Something like that, just to have it as a backup, as a third piece of paper. And you may want not to introduce that as evidence later on, but just so you have it. Now, how do you determine how much? I've heard different arguments used for this. I used to use the 3-month rule of thumb. The 3-month rule of thumb is this: the differential between what the unit could be rented at top market rent and what the tenant currently pays. So there are lots of units, like there's 3 and 4 bedroom units that they pay maybe $900 a month in rent, and it could be rented for $1,600 a month in rent. So that difference is $700. So a 3 months differential means I should be willing to pay up to $2,100 to the tenant to have them leave. And that means I got an ROI, right? An ROI of 400% on that money, right? I got all that money back in 3 months. The differential is 3 months. So I've heard other investors argue up to 6 months or a year. I know one investor says they always just pay 6 months of the differential. They go to them and say, hey, your rent's $900. I could get $2,000 for this unit or whatever. They've been there a long time. It's $1,100 difference. 6 months of that is $6,600 difference. They'll come there with $6,600 in cash to this tenant, or maybe it's a check. And cash has more of a, if the tenant's really poor and you bring them cash, it's really quite attractive. It's just static when you move.
There might be something wrong in the cable.
Better? Is this better, guys? Like if I just literally just set this thing on the table? I literally just disconnect. I pull this patch it. Oh no, I ripped my chest hairs out. It took me a whole life to grow those. Okay, so now it's just this little wireless receiver now. Just when I touch it, so don't touch it. No, put it back on your shirt. Too late now. Can you hear me?
No.
I'm not going to put it back on my shirt because I ripped the last of my chest hairs out and that hurt.
Yep, I can hear you.
Okay, so it sounds okay? Cool. Okay, so what was I saying? Lost my train of thought. Oh, Austin asked about how much do you pay tenants cash for keys and where does it make sense? I think up to 1 year can still make sense. If the rent differential is, say, $300 between what you're getting rent now and what you basically could be getting, it makes good sense because when you get your money back within a year, that's a great investment. That's 100% return on your money. So you get a 100% return on your money, that's great. But the other thing is this: the minute you get that tenant out and the new tenant at top market rent, the value of your building goes up substantially, especially in multifamily. So it makes a lot of sense because you get the rent up $1,000, let's say, on your building. Your building could be theoretically worth like $100,000 more. So if you have to spend $12,000 to get tenants out, you get that money back in 12 months. But you're going to get a $100,000 increase in the value of your building every day. So I, of course, try to save my investors money, and I use other strategies to get tenants out. But the best way is just to pay them to leave. Truthfully, you bring a lot of money to them, they'll likely leave. That's what it is. I bring $500 cash with me to sign these documents, and most of them see that kind of cash in front of them. You can, over text, wherever you say whatever you want, they won't agree to it. But when they see the cash in front of them and you're there in their presence, most people don't want to be confrontational. Most people don't want to offend someone. Someone's asking something of them, they usually will be like, okay, I want to try to find a way to work with what they're asking. Now, once they've signed that, they're not going to be able to probably find a place because they're D-class tenants. That's their problem because they've already signed. So make sure they get the N9, N11 signed. Don't agree to say, hey, when you move out, I'll pay you, and don't sign anything. Because that never works. They can never find a place, and they just never end up leaving. You got to go there, cash for keys, get it signed. It sounds ruthless, but if the landlords have been doing their job and raising the rent every year, they wouldn't be in this situation. The tenant would be used to paying closer to market rent. It's really quite sad, and these tenants have gone so long without rent increases, and their places have been so poorly maintained that now the shock of them going to market rent destroys their entire financial lives. It's really quite sad. So yeah, anyway, the answer is I try to do 1 month to start. I'll go up to 3 months differential, but the math says we should be able to go up to a year differential. So if they're paying $500 under market rent, you should be able to pay them $6,000 cold hard cash, and almost no tenant will not take that deal. Almost all tenants will take that cash for keys deal. So think about your sanity. What's it worth to get rid of this tenant? Sometimes putting out $5,000 up front, it's worth it. And the math suggests that it's a good return on your investment and a great place to spend your money. Now, if you get them out for free, that's a win, but sometimes you gotta pay. Hopefully that was good for you, Austin, to answer your question. If you're still watching. Okay, 100 push-ups tonight. Michael Chung, no. I just did push-ups, and I am so sore, guys. Oh. You ever notice do I look like I'm getting bigger? I feel like I've been putting on some real strength. Jordan says Facebook Marketplace has so much stuff you don't need. Yes, this is true. Everyone's getting rid of their junk. But one man's trash is another man's treasure. KGG free stuff is awesome. Yeah, exactly. William says, hi, Mike. My question tonight is, what do you think is the right long-term debt to equity ratio in holding real estate? Gotta run, eating with the family, thanks. So William's going to watch the replay probably. What is the right debt to equity ratio? I like, personally, 80% debt, 20% equity. So that means if I have a $5 million real estate portfolio, I'd like to have $1 million of capital tied up and $4 billion in debt or loans against the properties. If I have $1 million in real estate, I want to have about $200,000 of equity of my own in the property and about $800,000 of debt from banks or private lenders. That's the sweet spot. The reason for that is, well, one, you have a good amount of margin in case something ever happens. You've got like 20% in the property, which is fairly substantial. The second thing is you avoid private mortgage insurance, anything less than 20%, and you're likely going to need private mortgage insurance, CMHC, Genworth type insurance, and that's very expensive. It can cost upwards of 4% of the total purchase price on the property, which on a $500,000 building is $20,000 cash upfront, paid to CMHC, thrown into your mortgage, and you're paying interest on that $20,000 for the remainder of the life. So that's why I don't like CMHC financing. I'm a big advocate of avoiding private mortgage financing in Canada because it's an upfront fee. If you refinance the property 60 days later and you're back to 80% loan to value, because you can't refinance anything but 80% loan to value, banks will not refinance 95% loan to value. They stop at 80%. So if the benefit of getting into the deal lasted 60 days, was it worth $20,000 in insurance costs to CMHC to get you in at a cheaper price so you could renovate it and then pull that money out anyway? I would argue it's better just to pull the whole money out and be left at 20% down and borrow the difference between 20% down and 5% down from a private lender or a loan shark. It's cheaper to borrow at 17% from a loan shark than it is to pay CMHC their fee up front. The only environment where CMHC makes sense is one where there's no appreciation, no value add in the property at all, and you're going to buy this property and hold it forever, and the mortgage paid on is very small. So if you think the market will not appreciate, you think there'll be no gentrification, and you plan to do zero renovation and change zero tenants over and do nothing, it's just a turnkey building, CMHC financing can make sense if you're going to hold it for a long time. If you plan to sell, if you think there's going to be appreciation, if there's going to be gentrification, if you're going to be renovating and adding value to the property, if you're going to be changing tenants over and adding value to the property, any of those things, do not use private mortgage insurance, CMHC, Genworth type approaches. I just don't think it makes a lot of sense. So yeah, I like to be as levered as possible without having to pay insurance. The more leverage, the better, because your return on your invested capital is really cranked up the less of the capital you have in the project. So again, I like 20% down. A lot of people get to a point with a little bit of appreciation, a little bit of renovation and value add and tenant turnover and mortgage pay down. They get to this sweet spot of like their mortgage is like half of the value at market value of the property. And it's a mistake, I think, to hold a real estate portfolio without refinancing and pulling that equity out and putting it to work into other places like buying more properties or investing in the stock market. Because you can go borrow that money out at 3 or 4%, likely even like 2 to 4%. Some people are getting 2.5%, 2.3% interest rates. It's dumb. It is straight up bad investment decision to not pull that money out, William. So if you have that equity in your properties and you can't refinance it out, well, first you should try to refinance it out because it's a tax-free pull out of your property. You pay no tax to refinance the money out. But if you can't do that, it still can make a lot of sense to sell your portfolio, sell some properties off that are, not generating a ton of cash flow at market prices. So maybe at market price for the property, you have a ton of equity sitting in the property. Doesn't matter what you bought it for, matters what it's worth today in the open market and what kind of cash flow you're getting based on what's worth today in the open market. Because I would sell it and rebalance my portfolio and buy, I'd sell one that's mostly paid down, halfway paid down, let's say, at market price. Say I bought it for $500,000. Originally I had a $400,000 mortgage, but I've been paying the mortgage down. Now the property's worth $1 million and my mortgage is at like $300,000. There's $700,000 in equity. It makes no sense to not refinance that capital out. And if you can't refinance it out because the bank won't give you enough money on that, they won't give you that because you don't have the financing, you don't have the net worth requirements, or you don't have the income requirements to get that approval, then just sell the property, take your $700,000 and buy 4 more. Or buy 1 more, 20% down, and take the rest of the money you got left over and invest it in the stock market or something to that effect. Put that money to work because it's not working very hard for you. Buying real estate in cash is not a good way to deploy your capital. You should really be wanting to use leverage. That's what makes real estate so attractive, is leverage. Great questions. A lot of this content is fantastic for the main channel. Good questions. So William's going to catch up at the end. Okay, so Jordan meant a 4 or a 3-plex. So Jordan with a triplex and a 4-plex, you can use the same sort of strategies. The net operating income approach does work for a lot of appraisals on the 4-plex end. They will treat that. A lot of the appraisers will treat income approach as the main way to value the building. Some of them still use comparables. It's tricky. But the same stuff I talked about, all those strategies to create value by changing tenants out, renovating, all of that value add stuff works the same on a triplex. I use all those strategies on a triplex or a 4-plex as well. Make the new buyer feel comfortable. Angie says, have you thought about putting additions or adding second stories to your properties? Why have you stayed away from that? So Angie Ferns asks a great question. So how do you determine if it's worth it to dig down or build up or build out? So digging down means underpinning. A lot of people will dig down their foundation. They'll dig down inside their basement and they'll do something called underpinning, and they'll drop the basement floor to get really good headroom in their basements and then put secondary units in there and more living space. Other people will put additions on their properties out the back or the sides, and other people will build up. Why have I not done that? So here in London, Ontario, there are a lot of properties still that are trading below replacement cost. What that means is I'm buying buildings. I bought a house for $145,000 in London, Ontario here. And it's a single family house, 3 bed, 1 bath. Now a property like that, I couldn't build it for $160,000 with the land. They're trading for below what the build cost is. It makes a lot of sense to, this is a great little snippet for like an Instagram, but how do you determine whether it's worth it to put an addition on or build up or build down? The price per square foot of living space has to justify. So in Toronto, where living space is super, super valuable, right? Where square footage in a building means a lot. The dollars per square footage, right, are worth a lot more than in London. So if you have an extra 100 square foot on a building in Toronto, it might be worth $100,000 or $200,000 more. In London, that extra 100 square feet is worth like $30,000 more. And so the cost to underpin a foundation is almost the same in Toronto or London. To build up, very similar. To build out, very similar. It can make sense to build up when you have really high cost per square foot. In London, I'm just finding it's better just to buy properties that are a little bit run down, and I can buy a whole house for less than it would cost me to build. So when the build cost is, as high as it is right now, because lumber is very expensive, trades are in high demand, it just doesn't make sense. If there was a market where it was cooling and I could get trades really cheaply and lumber costs came way down. I could build really cheaply, or I had some advantage with building. I don't have a huge advantage with building. And plus, it's really annoying to go to the city and get permits and get all the zoning requirements to put additions on. It's a lot of work. And I figured for all the headache, it's way easier to renovate an existing building and make better use of the existing footprint that's there, or just buy more properties. Rather than putting an extra $100,000 into a building to build up, I'd rather just spend an extra $100,000 and buy the house, 2 blocks over and get a whole house. So it just hasn't made sense in London for me. In Toronto, in some markets where it's really hot, it can make a lot of sense. And in markets where it's really cool, it can make some sense. But mostly you see people building up, building out, and building down for an emotional reason, or if the cost per square foot of real estate is really high. Because if the cost of the real estate is selling at, say, $250 a square foot, and you can build more square footage for $140 a square foot, which is actually pretty standard. In London, you can build about $140 a square foot all day, and that's building nice. So if that's the case, then you make $110 on every square foot you build. So then it makes sense to build up, build down, build out. It just, in London, is so close, the resale cost for real estate per square foot to the cost to actually build it, they're so close. You can make a little bit of money. I know some people making a little bit of money doing it, but the amount of money is not substantial enough to warrant the effort, in my opinion. Now, if I was in Toronto, I'd be doing that. I'd be underpinning in Toronto. If I was in Vancouver, I'd be underpinning. For sure I would. You got to run the numbers, and in my market, it just hasn't made sense to do that. Good question. Great question for a little Instagram segment or something. Okay. How do you structure private lending? Hey, D's information. Good to see you on. Justin, good to see you on. So Andriy Kulkovich says, how do you structure private lending, like loan to value and collateral on their money? So how do you structure private lending? There are a bazillion ways to structure private lending. But, so I would say there's like several tiers of private lending. You can private lend for businesses. You can private lend for real estate. I assume we're talking about real estate because it's the Mike Rosehart Show, and everyone asks about real estate on the Mike Rosehart Show. I don't know why no one asks about personal finance stuff, but we always like talk real estate, and I guess I am an expert at that. I'm a SME. I'm a subject matter expert when it comes to real estate, so that's cool. I used to be called a SME at my old job. I was a SME in like certain areas of leadership development. But anyway, so I'm actually repping the shirt right now where I used to work. But, okay. How do I start with this? Private lending. What is private lending? Private lending is when one person lends another person some money, and no financial institution was involved. So one person lent another person some money. Maybe it was to buy a business. Maybe it was to buy real estate. Often we use it in the term to buy real estate. I consider private money to not be financial institution money. So it's not credit union money. It's not bank money. It's Joe's money lent to Sarah. It's Sarah's money lent to Paul, etc. So that was what private lending is. How do you structure it? It depends on the deal. It depends on what you're trying to accomplish. I like in the unsecured space. So the first type of private lending is unsecured. So that type of lending is basically you're lending to someone and there is no guarantee on the building. So you're lending to someone to buy a property, to renovate a property, but you're lending it to them unsecured. This should come with the highest rate of return because you're not secured to any building and you have no guarantees. Unsecured lending typically is written in just a note. You'd write a note to someone and say, hey, I owe them this amount of money. They're going to pay me this amount of interest. It could be a balloon payment where at the end of the term they get paid all of their interest, or it could be a monthly interest payment and then full repayment of the loan at the end of the term. It could be they're making principal and interest payments on the monthly. There are several ways to dissect that type of private lending. I think that there's just so many avenues with private lending that it's tough to cover it all in one video. But there's the unsecured space where you're doing it that way. Then there's like the unsecured space with personal guarantees. Now, if you're lending to people who have significant net worths, so people who are very wealthy, have millions of dollars in net worth. So their assets are much greater than their debts. If that's the case, you're lending to like people, I know some real estate investors that I've lent to and have lent to me, where they're well ingrained in the network, everyone knows them, and their net worth is, say $5-10 million or something, right? Those people have such high net worths that you would get them to just sign a personal guarantee. And in the event that they didn't pay you back, you could sue them and take it from any of the equity in any of their properties or any of their other assets. That's really important because if you're getting a personal guarantee, it needs to be against someone who's got a strong net worth. You get a personal guarantee against a guy who's got one house and a bunch of debt, it's worth nothing. You get a personal guarantee against a guy who's got $1 million in investments in his accounts and several $1 million in real estate and whatever else. That's a strong personal guarantee. In fact, in my opinion, that personal guarantee is stronger than a second or third secured mortgage. I feel more comfortable lending to someone with multi-millions, personal net worth that will personally guarantee it against all of their wealth. In fact, if the project fails, I will sue them and take it from their personal worth. I feel better about that than I do about a second or third mortgage. Now, the other type of lending is first, second, third secured mortgages against properties or against businesses. So a secured mortgage is where, or secured loan or private lending that's secured is when you secure against title on a property. So secured lending, you can be in the first secured position, the second secured position, or the third secured position, et cetera, et cetera. Most people don't go past the third, but theoretically you can have a fourth or a fifth secured position. The way it works is this. If you're first in line, you have the right to power of sale, take the property back if they default on their interest payments, take the property to get your money back. So you take the property, and if you're first secured, you're first in line to get money. Typically, people will go 75 or 80% loan to the value of the property in a first secured mortgage. And the second secured position would be in a position where they'll take that remaining 15 or 20% of equity in the property and lend against that. And so after the first person's been paid back, the person in second secured mortgage position would claim whatever was left over. The third secured position would be even further what is left over. The better, like first secured is the best position to be in, you have first claim on the property. So if you're first secured lending, you should expect a lower rate of return because your risk is very low, especially with Canadian real estate. So if you're first secured position on a property and you are 75% loan to value, it's important what percentage of loan to value you're willing to go. On a first secured mortgage, if you're 75% or 80% loan to value, then you're in a position where there's 20% of margin that you can fire sell this property to get your money back, and you'll still guarantee get paid. So if you sold this property, let's do an example. Let's say someone bought a $200,000 property. Now $200,000, let's do $100,000, it's even easier. $100,000 property. Now, if you're willing to lend a first secured mortgage to the person, 80% loan to value, you'd be willing to lend them $80,000. You'd say, hey, this building is worth $100,000. The appraisal confirms that. Maybe they're planning to renovate it and have it be worth $150,000 when they're done the work they're going to do to it. So it will be eventually worth $150,000. But you're saying, okay, right now I feel really comfortable it's worth $100,000 and there's upside, and I'm only lending $80,000. So in the event that they default and they don't pay me my interest payments, they don't want to pay me back, I'll go through the power of sale process and take title. They will lose control of the property in first secured mortgage position. I will take the property. It becomes your property as the mortgage lender, and you can sell the property to recuperate your money. So you'd force the sale of the property. It would sell for, say, maybe $110,000. Maybe in a fire sale, it would only sell for $95,000 because maybe they run out of money mid-renovation and the walls are all ripped open. It's the worst case scenario, so you get like $90,000. You were in first secured position, so that's okay. You get your $80,000 back plus your interest. Maybe you take $84,000 and you're all good. And there's still a little bit of money left over for the person who owned the property who basically borrowed the capital from you for the first secured mortgage. Now, typically first secured mortgages are in a position where they're charging anywhere from A-lender rates at like 3% all the way up to, I've seen first secured mortgages at like 8 or 9%, depending on a number of factors. Interest rate per year, 8 to 9% interest rate per year is the max I've seen on a first secured mortgage. Second secured mortgage is taking more risk. They're lending in that second secured position. So in the event of that default, let's say it sells for $95,000 or $90,000. Let's say it's $95,000 for easy math. So they got $5,000 less than they bought it for even, which means that we're in a recession and everything has gone wrong. The second secured guy maybe this person used 2 mortgages to buy the property. Maybe they got a first secured mortgage from the bank to buy the property and a second secured mortgage for the down payment. So someone else lent them a second mortgage on the property. And they secured against title because the person had no net worth and that was all they could secure against. And there's nothing else for collateral. Collateral is basically what they're putting the loan against to guarantee they get paid back. So the person had no personal wealth guarantees, so they had to put get collateral against that property in a second secured position. So in the force of that sale, let's say you lent them $20,000 to close on the property, and the other person lent them $80,000. You're in the second secured position. Now it's sold for $95,000. You're stuck only getting $15,000 of your money back. You're out $5,000. Now at least you got most of your money back. They couldn't not pay you back because you took the property and you were in the best position. What's great in this market where we're having a lot of appreciation and more people are adding value to properties is if you're investing in a property where they're adding value to it, oftentimes it's worth $130,000. So you have fire sale and you throw a ton of fees on, and you end up getting paid back all your money, even if you're in the second position, and all your interest and some fees for your trouble. Oftentimes you'll put things in there like that. Like if they, in the event of default, the interest rate will jump up to 15% interest. So if the person, this happens all the time in second mortgages where it's like, hey, we're going to charge you 10% interest rate on the second mortgage, and if you default, we have to go power of sale it, or if there's any default at all, it goes to 20% interest or some really high number so that they can guarantee get a good return on their money for the hassle. So first secured mortgage, second secured mortgage, third secured mortgage. I do a lot of first secured mortgages from A lenders like banks and credit unions, and then I borrow capital privately against my net worth for the down payments or renovations, and I basically put that capital to buy the property. I unlock a ton of value. I buy these properties for, say, using the example of a $100,000 property. I sell it for $200,000, or I refinance it when it's worth $200,000. I'll go refinance it and get a mortgage on it, 80% loan to value from the bank. For on $200,000, 80% loan to value is $160,000 mortgage. So $160,000 mortgage. I get that money from the bank. I can pay out the first secured lender $80,000. I pay them out. Boom, got $80,000 left over. I pay back the unsecured loan of $20,000 that I bought for my down payment, pay that out of the money too. Okay, now I'm at $100,000, right? I had no money in the project, and now I'm left with a check for $60,000 in my pocket. That's a perfect example of a BRRRR. So where I took all the risk, I borrowed the money to put the deal together, and then I made all of the profit. So that's basically why people do private lending and why it can be a win-win situation. It's great. I like private lending. I have some loans out too. I also lend to some flippers and stuff. It's nice to get, on a 10% rate of return on $120,000. I lend on $120,000. I get $1,000 a month in passive income. I do nothing. That's not bad. $120,000 in a property down payment could net me maybe $1,500, maybe $2,000 a month. Best case scenario. Probably more likely than not, I'm going to make like $1,200 or $1,300 a month in cash flow. So then you make $1,000 a month for zero headache, zero work. The money just comes to you every month. You let the person you lent to deal with all the stress, whether the project fails or doesn't fail. You don't have to worry about it. All you care about is getting your interest payments every month. If you're lending to someone who's doing this all the time, who's an expert, it's probably going to be fine, especially if they're rich, because then you can just go sue them. If that project fails, you just sue them. So that's, yeah, I mean, I've never not repaid a debt. I'm in a really good position. So when I borrow money, it's like I can pretty much command whatever interest rate I want, just because I have a lot of friends who know and trust me, and I am very wealthy, so it's easy. The wealthier you are, the lower the risk, right? If you're lending to someone who's broke, there's a bit more risk. If you're lending to someone like me who's got a few $1 million, it's a lot lower risk. For me to have one if the one project you're investing in goes bad, I've got 50 other buildings to cover that bad project. If the guy who has no properties, his first deal goes bad, there's a bit more risk there, right? So I think interest rate has to be relative to the risk that you're taking. So if you're backing someone who's never done a deal before, who's done like 2 deals, 3 deals, they're smaller, just starting out, maybe you charge them 12 or 13 or 15% is not uncommon for unsecured borrowing. I've seen in the unsecured space, 10 to 15% interest rate all day long. In the first secured position, I've seen 3 to 9%. Second secured position, I've seen 7% to like 15%. Third secured position, I've seen 20% and higher. So that's private lending. That's, in a nutshell, private lending. Now, sometimes brokers will facilitate an investor who has capital, who wants to lend out, and maybe a real estate investor or a business owner who wants to borrow money. There'll be a broker, mortgage broker, they'll facilitate that connection. And when that happens, they take a lender fee. So they'll come in and say, okay, you're lending him $100,000 mortgage or $100,000 loan. I'll take 2% lender fee. Very common is 2%. So they're going to take $2,000 fee. So the guy who's borrowing the money has to pay the interest to the investor at 10% or whatever the negotiated rate is, 8%, 6%, whatever. Depends on the risk profile, whatever project they're working on. And they have to pay that guy to make the introduction, $2,000. If you want to borrow money right now, it's not that hard to borrow money. You go on Kijiji. My mentees are doing it right now. We're doing a little test. I'm going to see if my mentees can buy zero down properties. Can they borrow the money? I'm going to give them really good deals that are under market value and see if they can put properties in their own names with none of their own money. Totally doable if you have the right deal. But I'm going to show you that with private money you can do that. Now the cost of private money is more expensive. So ideally you want to stabilize the asset and get a lender financing at some point, right? But getting a good deal done, even with expensive financing, can make a lot of sense if the deal is sweet enough, right? If you're buying property that's significantly under market value, but it cash flows very strongly, you can borrow at 10% and still cash flow. Not as well, but still cash flow. And a property that's cash flowing okay is better than no property at all, in my opinion. And so we're going to do a little experiment showing you how to build a real estate portfolio without having to qualify, without the income to qualify, doing it just with private money. Going right now in Kijiji, there's like 50 lenders. There's actually like 80 lenders. I went through and made a list of all of them. And Jonas is working on it right now. We're going to send off applications to a bunch of them. And someone is probably going to come through and prove that you can borrow money privately and put real estate deals together with none of your own money. That's the beauty of real estate investing, is you can do it with none of your own money. You can't invest in stocks with none of your own money. You can do it with real estate. You can borrow the money from people who've got it, who want to make a decent return like me. I actually am going to start a mentee fund. I'm going to do a video on it. I haven't done it yet, but I'm going to do a video on it where I seed my mentees with down payments. And the fund basically is going to grow. I'm going to make some money. I'll be happy to make my, say, 10% return. If I get $1 million, I get to make, 10%. That's $100,000 a year. I get to make $100,000 a year passively, and they all get to make $100,000 a year too, because they get half of all the profit, and they get to run at properties with no down payment. So that's a cool thing that I'm getting really excited about, is being in that position where I'm the investor. I like to say, I get to change these people's lives. So being a private lender, you have big impact on these real estate investors' lives. You can potentially, some of the private lenders who helped me in the beginning, who lent me some, I remember I had like 3 or 4 projects and I was out of money. I couldn't finish the renovations. They went way over budget and tenants didn't leave when they were supposed to, and everything that goes wrong can and does. I remember there was a time where I had very low liquidity. This was about 2.5 years ago, 2016, 2017. And I had a few friends actually did a Facebook post. I used to do a daily video journal, and I might start doing that again just for fun, to document. Because I'm enjoying going back and watching them now, 2 years later, where my headspace was at. And it'd be cool to see in like 5 years from now where I'm at now. So just documenting the process. But the really cool thing was this. Friends came out of the woodwork you wouldn't even expect. He's like, one friend had like $70,000. He was like, man, I have money just sitting around earning 2% in a savings account. I know you. I trust you. I'd love to see you invest that in real estate. I don't want to own real estate. I don't want that hassle, that struggle, but I'll lend it to you and I'll make 10% return. And I was like, okay, that solves my problem because I need capital to finish the renovation, to make hundreds of thousands of dollars once all the renovations are done, so I can make a ton of money. He knows there's lots of margin in the properties because I bought them all 20% down, so I got all my equity in the property, plus however much I spent in renovations. So they got a lot of safety net. They know I've got lots there. That liquidity allows me to finish the projects and refinance them. Some of them I sold off. And so they lent $70,000 out. They make, $500, $600, $500, $600, $700, $800, $1,000 a month in passive income. Don't have to do a thing. So that was a cool position where it really helped change the trajectory of my investing career. Like I was at a point where, an inflection point where I would maybe not have made it to where I am today if I didn't have some of that private capital. I didn't figure out how to raise that money to get the deals done. So I think on the investor side, it's a really cool position to be in when I get to change these guys' lives. Because now I get to be the guy that seeds their down payment, that seeds their renovation. And I get to sit back and mentor them to ensure that my investment's, well looked after, because they're using my money to renovate. I can make sure that the investment's well looked after because I'm mentoring them through it. It's really a win-win situation. And they get to win because they got a bunch of properties. At the end of this, they have a bunch of properties that are cash flowing. They're financially independent. And so I get to change lives and make a great return on my money. So I love private lending for that reason. You get to be involved and have an impact in real estate without having to do any of the work. Because I'll be honest, being a landlord sucks. And being a property manager sucks. Being a contractor, it sucks. When you get to the next level, when you get wealthy, you built the wealth, you've grinded through being a renovator, you've grinded through being a property manager, whatever you've been doing, property management. You get through all of that, and you realize how hard it was. And if you're going through it now, you're going with those rough tenants right now that are texting you at like 5 in the morning with water leaks. I feel for you. I've been there. I'm still sort of there. I'm not in day-to-day as much, but I'm still there with you. And yeah, private lending. It's a win-win situation. I love win-wins. The real estate investor wins, and the basically the investor providing the capital can win a ton too. So just be careful about how you do your private lending. That was a great question. I'm glad you sparked it up. I'm in the mood now to keep going with some more questions. I was going to wrap it up early today, but you know what? Let's do it. Let's keep going. So Austin says banger. Bang her? Who am I banging? That's. Put that away, Kyle. Just kidding. Okay. Hi, Mike. I have about 80K in equity, but I don't have a job at the moment. Is it difficult to qualify for a mortgage? What do you think I should do? Chen, I think that it is very difficult to qualify for a mortgage from an A lender or a B lender without a job, unless you have a huge net worth. 80K is not a huge net worth. It's a down payment on the property. I would say if you want to buy real estate, joint venture with someone. You've got 80 grand, maybe someone else has a job and no down payment. Joint venture, 50-50. All of a sudden you got a property. They qualify for the mortgage. You bring up the down payment. Ebony, ivory, living in perfect harmony. Right? It's like two things come together and you got something really good happening. So joint venture partnership is a great way. You could just lend that $80,000 out. Maybe you don't want the stress of managing a property and all of that, and you don't want the risk of owning the property yourself. You just want someone else to do all the work and take the risk. Find an expert in the field. Find someone who's like me, basically, that's doing this. There are a bunch of me around. I think I'm probably the best in my area. I'm biased. I think I'm having the best returns. I don't know anyone who's getting the kind of returns that I am, but maybe someone else is. Find someone who's getting great returns on the real estate portfolio because they have huge margin to guarantee they can pay you your 10% interest that you're looking for. So I would happily take your $80,000 and invest it into a project that I'm working on, like a fourplex or something, fund that project and pay you a 10% return annually, but pay you out monthly. So on $80,000, that's $8,000 a year in interest, which would be paid out divided by 12 on a monthly basis. So there you go. You have $500, $600, $700 a month coming in. Maybe it would be enough to even pay your rent. Instead of having the money sitting in your savings account doing nothing, it could be generating you passive income, and you get to be part of this, the whole movement. A lot of my investors that lend me money, they feel like they're part of the project. They go on Instagram, they see the pictures where I'm at the properties, and they know their money is hard at work building that and changing communities. Because I go in and buy derelict buildings, and I transform them and provide great places for people to live. I'm changing the landscape of London. 280 people live in my properties. I provide a good amount of housing in London. That feels good. And to be lending into that, you're helping change the face of London. You're helping house A and B tenants, giving them great places to live. And I mean, that's a good thing to be a part of, I think. That's why I like lending, because you're making a change without having to do any of the work. And that's the key thing, is not having to do all the hard work, the grunt work. Jordan says, I have one property in the GTA. I can refinance, but it will not have good cash flow if I do. Can you refinance and then sell to avoid the tax burden of capital gains? So this is a very difficult question to analyze, and I touched on it a bit earlier, but refinancing is always your first step. So if you can get a refinance on the property at current market value, you can get a great appraisal for what it would sell for, and then get the bank to give you 80% of that appraised value, do that first, because then you don't have to pay any tax. Now, if you've lived in the property at any point in time, it's probably capital gains tax free anyway, because you lived in it or you still live in it. Or a good portion of it could be capital gains free for the years in which you lived in it. So that's something to kind of think of too. If it's your primary residence, probably just sell because there's no tax implication at all. I sell my primary residences because there's no tax implication when I sell them. Now, how do you know what to do with that money? I guess in your case, if there's no cash flow after refinance, that means you shouldn't own that property. It's not a cash flowing property. If at market value, fully levered, it does not cash flow, it is not a property that should be in your portfolio. That is my opinion. I think you should sell it and buy something else that does cash flow at market value. And so it's like, it's like owning shares in Apple. And let's say Apple triples in value, and you're like, hey, Apple's fully tapped out in value. I'm going to sell it and buy the next Apple, right? And it's a little bit more predictable in real estate. I literally can go in and say, hey, this property is worth $1 million or like $500,000 fixed up. I can buy it right now for $350. Spend $50 renovating it. I'll make $100,000 clean, guaranteed. So I could just continue to turn my money. I don't want my money to sit in a property that's already fully tapped out and not cash flowing that well. I want to keep my money churning, right? Keep cycling the money into more efficient vehicles. So I would recommend you should probably do that. Talk to your accountant, obviously, and et cetera, et cetera. to make sure that's right for you. But I don't think it makes sense to own property that doesn't cash flow at market value. And in fact, I put my money where my mouth was and sold 11 of my own properties out of my portfolio that did not cash flow near as well. And then I went and bought a bunch more buildings that cash flow way better. I sold one building, took the money out, and bought 3 more with the equity that I had created. So I practice what I preach to you guys. I sell properties. Someone who doesn't sell any real estate ever, like there are a lot of investors I talk to in real estate who never sell. They're like, hey, I'm owning this property forever. That's a terrible mentality. It's the worst mentality. Imagine you went as a stock investor and you're like, I buy stocks, but I never sell them. It's like, what? Like, you should treat your real estate portfolio like a stock portfolio. And when certain properties in certain areas become overvalued, you should sell those. You should harvest the gain and move on to another better valued play, especially in real estate, because the more you churn, the better it is, because you unlock all the value. Once the property's been fully renovated and max rent, best tenants in there, you've tapped the value out. It's time to move on to another property, renovate it, put better tenants in, etc. Repeat the process, and you make a bunch of money every time you buy a new property and you go through those steps, right? Every time you burn a property, you make a bunch of money. So if you're just tapped out and you have no more properties, you're not burning anymore. You're not really creating a lot of value for yourself. And so I think there's an opportunity to do that. I've seen people who have real estate portfolios that are 50 and 60 and 70% paid down. So their current mortgage is like $300,000 and the property's worth $1 million. They got like $700,000 in equity sitting there because he bought these properties for $400,000 or $500,000. They're probably doubled in value. They've paid their mortgage down a bit over time because, as you make mortgage payments, it pays down the mortgage. Maybe they renovated the property too. So that just created a big divide between what your current mortgage is and what it's currently worth. You've got a ton of equity trapped in there. Some of these investors, like I talked to one guy, he's like, I'm making $1,500 a month. $700,000 in equity trapped in your property, and you make $1,000 or $1,500 a month. That's $12,000 return on $700,000 in capital. What is the number on that? I should pull my phone and do it. It's really bad. The number is really bad. Take the $700,000 and lend it to someone who's doing real estate flips or doing, buy and hold strategy or whatever, BRRRRs. Lend to them.
Calculator.
Yeah, this is calculator. Okay, so let's say you make $1,000 a month in cash flow on a property with $700,000 in equity in that property. Very common in Toronto and Vancouver and big metropolitans like LA and stuff. For people who've had properties more than 5 years, because mortgage pay down eats away at your mortgage and you can't refinance because the bank says, hey, you can't handle any more debt. We're not going to give you any more, blah, 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 blah. Or you refinance the property and it doesn't cash flow, in which case it doesn't make sense to hold the property anymore. But $12,000 a month in cash flow, in return on $700,000 is 1.7% return on your money. Go put it in a savings account.
Yeah, that's a savings account.
Like, actually, there's a lot of people in Toronto and Vancouver who are getting terrible returns on their money. And they're bragging about it. I watch their videos on YouTube. And they're like, I'm making $5,000 a month in cash flow on my 6 properties in Toronto or Vancouver. And I'm like, you're proud of that? You're proud of that? You got $1 million sitting there generating you like a couple $1,000s a month? That's terrible. A lot of these investors are getting bad returns on their money. So there's a bunch of dumb real estate investors out there. We've established that. And like, it's not rocket science to do real estate investing. To do it well and do it at the level that I do it at, you got to be smart. But to do real estate investing in general, you don't have to be very smart at all. In fact, most people make their money in appreciation, which requires dumb luck. But anyway, what you should do, if you've got to this point, it doesn't matter. What matters is you're here and you've realized that you have that equity in the property, which I did. That's why I sold 11 of my properties off. I was like, hey, I got a couple $1 million in equity here, and I could go lend that out. I have a private lending opportunity where it was a bit riskier, but I could make 15% guaranteed, like pretty much guaranteed. And it was paid monthly. So 15% guaranteed on $2 million is what? $300,000 a year in passive income. I thought to myself, is my current portfolio, net of all my expenses, net of vacancy, bad debt, maintenance, all the bad things that creep up, tenants leave and destroy a unit, after net of all of that, was I making more cash flow for my real estate portfolio, which is a lot of it had been paid down because it appreciated a ton, and I had a lot of renovation value, and I couldn't refinance. Went to the bank, was like, hey, can I pull out $1 million in equity? And they were like, no, we don't want to lend you. Like, no, we're not going to lend you this money. It's like, okay, darn. I've got like 12 mortgages. I'm tapped out. Nothing more I can do. I made the decision to sell. And I did it over 2 tax years to split the gain. Like, I was very smart about it. I split it over a couple of years and, split the gains out between my wife and I and all that. I was very smart about how I sold them, and you should do that. Be smart about how you sell it. But I took that, if you take that $2 million, even net of tax, call it like $1.7 million, and invest that at 15%, right? My $2 million was making $300,000 in potential interest income. Could make $300,000 in income. My portfolio was generating about $150,000 in rental income. So I was making about 7.5% return on my equity. That's bad. That's not good, right? Net of course, there's appreciation and other things that were helping me get a better return than 7.5%. But it made sense to sell. No stress, no headaches, more money. Now, even if my portfolio is making $500,000 in cash, and I could make $300,000 passively, I would still sell and take $300,000 for no work than $500,000 for grinding, right? It can make a lot of sense. Take that $700,000. Look at that example I gave you where they're making $1,000 a month. They're bragging about it. They have $1 million property in Vancouver or Toronto, and they make $1,000 a month, positive cash flow, blah, blah, blah. They're so happy. They've done so well on their property. It's doubled in value. They should sell it. They won't. They're emotionally attached. They think that's going to, that this $1,000 a month is great money. They could take the $700,000 and invest it at 15% with a private lender. This phone's off now, but I can probably do it in my head. So $700,000, 10% is $70,000. So it'd be $105,000. Did it in my head. I don't need the calculator. So $105,000 in interest income on $700,000. So they can make $105,000 a year, or they can make $12,000 a year by keeping the property. $105,000 by selling the property and investing all of the equity in private lending, invest it in real estate, do it in mortgages against other properties with significant margin upside. Make sure you're investing, maybe you do like investing in properties that have a lot of upside equity, so you're really protected and really safe, equally safe, That to me is a no-brainer. So there's too many people that keep their properties. That was just a rant. Maybe I should make a video out of that or something, but it just grinds my gears how stupid people can be. And I was one of them. Like, I was the stupid person too. I was like, hey, got all this equity, and I'm making all this cash flow. I'm talking about it on Facebook, like, hey, look at me making all this cash flow. I can make way more cash flow for zero work. Private lending. It's a great solution once you build up a ton of wealth. Or you just invest with guys like me, and you make me do all the work, and you get all the upside on the properties. Because my investors are all making like 50 to 100% return on their money. They're taking more risk, granted, than private lending, and there's a bit more work because they have to get approved for the mortgages and whatnot. But there are lots of options, lots of ways to skin the cat. But probably owning a property that doesn't cash flow in Toronto, Vancouver, New York, LA, Hong Kong doesn't make good financial sense. It might make emotional sense, and that's not a good enough argument for me. Sorry if I just offended some people. Okay.
I'm going to be one of those stupid guys eventually.
That's okay. I've been retarded. Why is this mouse not working? There we go. It's working now.
Battery maybe. Oh, I bet you it's a piece of paper.
Could be.
It's laser, so the white's probably reflecting the laser back at it.
Okay, let's go up here and get the next question. Now the mouse is working. I received a quote for $223 annually for umbrella coverage, Dee's information says. I have not shopped it around, I just called one company. Does that sound reasonable? Thanks. So that's just liability coverage, I'm assuming. D's, that seems pretty reasonable depending on the number of properties that you have. Umbrella insurance is this. Basically, instead of having individual policies that each have liability coverage on your property for $1 million or $2 million, you get one umbrella for, say, $5 million that covers all of your properties. And in the event of a lawsuit, they sue and you get covered up to $5 million. So the reason that's better than having five $1 million policies, right, is that if you have one fire at one of your properties and someone dies and they sue you for $1.5 million and they win, your insurance will cover $1 million of it and you'll be out of pocket $500,000. Now with an umbrella coverage, chances are not more than one property is going to have a fire. Not more than one property is going to have a major catastrophe or someone dies, right? And you got an umbrella coverage. So they sue you for 1.5, you got $5 million in coverage. It's an umbrella policy, covers all your properties for one large amount. It's the same cost typically as five $1 million policies, but you put all your house policies together and get an umbrella insurance policy. So it's like an umbrella that covers all your properties and it catches more rain. It's just a better policy all around. I'm a big fan of umbrella policies. That seems like a reasonable amount. I don't know what other factors are at play here. I don't know what kind of coverages that you got liability-wise or how many properties you're covering, but that seems pretty cheap. Umbrella insurance can be very cheap, oftentimes even cheaper than having individual policy insurance. And there's liability policy required with your mortgage on every single property. So you're required to have insurance on every single real estate property that you own. Your mortgage will require that. Most A-lender mortgages will require that. Most B-lender mortgages will require it too. So you have to have insurance. Might as well get the cost-effective option that'll protect you against major liability downsides. Good question. Do you think income tax is too high? That's a very generic question, but a good one.
Yes.
I think that the system is actually broken, and I love it, for the $50,000 in income range if you're collecting dividends. So I'll give you an example. Joe and Sally. Joe and Sally are early retired. They're financially independent. Joe collects $48,000 a year in Canadian eligible dividends from Canadian stocks that are paying out dividends. It's $48,000 a year, $4,000 a month in dividends. And Joe and Sarah? Jane or whatever. Okay, so his wife, she also gets, because they split their fire fund. So she has $1 million, he has $1 million, and they invested it, and they each own shares, and they're financially independent. And she's making $48,000 a year in dividends. So they're bringing in just under $100,000 a year. Here in Canada, Canadian eligible dividends get a gross up tax credit. If you have no other income, $48,000, it goes up to about around $50,000 in dividend income, is tax free. So in Canada, you could collect eligible Canadian dividends, $50,000 a person, so $100,000 a year, more than anyone needs to live. Trust me, I'm frugal. You can live on $100,000 a year. Like the least frugal person possible could live on, like 5 of my families could live on $100,000 a year. But anyway, that's another conversation if you can't live on $100,000 a year. But $100,000 a year, completely tax free in Canada. The US has very similar policies. Also, the first $12,000 of active income per person, so 12,000 times 2, 24,000 as a couple, tax free. If you're financially independent, you're finding ways to keep your income low, you don't have to pay a lot of tax. I don't pay a ton of tax. This last year I had like $200,000 in capital gains, so I paid a lot of tax. That's because I have a lot of income coming in. But I think that this system, if you know how to work it, is very good for the financially independent. It is very good for people who know how to use it. In the US, they have the 1031 exchange. It's a beautiful thing. I don't think the tax system is broken. I think it's pretty good. In fact, I think it's almost in our favor. All of the fire people, we have the best situation ever. We can pay almost no tax in retirement. We can be multi-millionaires. We're getting $100,000 a year in dividend income, pay no tax. Now, if we start earning active income, we pay a ton of tax in Canada. But the tax system is progressive. So the first $12,000 in income, you pay no tax. Then the next, $40,000 in income, you pay like 16% tax federally and like 12% tax provincially. I don't know the numbers. I'm just giving you random examples, but roughly like a quarter of your income in tax. Then the next income from like 46,000 bracket to like 80,000 bracket, you pay a little bit higher tax rate. But your average tax rate, even if you're at 100,000 in active income, not from dividends, not preferred, right? Just like active employment income, you're paying top marginal bracket on. Only that top amount of income you're making is taxed at like 46%. The rest of it's taxed, the first 12,000 is taxed at nothing. So your average tax rate often is like 30% or 35%. It's not near as high as people think that it is. People complain they're paying all this tax. We often don't pay near as much tax as we think that we do. Our average tax rate is much different than our tax bracket the highest tax bracket that we're in, because it's the average of all the different brackets that we're in. I think the tax system is fair because we need that money to keep our cities going, to support the bottom of society. If we didn't support the bottom of society, like those deadbeats, they would just like break in our houses and steal stuff. They would like kill us, right? They would just revolt. Yeah, like the bottom of society will revolt. So you can't have extreme inequality. I think that, I think we could be more efficient stewards. The government there are a lot of people in the government system that could be more efficient stewards of the money. They could do a lot better job of putting that money to work in better places, way more efficiently. There's a lot of corruption, a lot of bad spending. I don't agree with how they spend all the money, but I think the money that's coming in needs to come in, and some of it. So I'm willing to pay that to keep the fabric of my society together. So that's a cost I'm willing to bear. And that's sort of my take on income tax. pay your income tax. Yeah, it should be reasonable. I think 50% is too high. I think like 30% would be great as a top marginal bracket. And I think, yeah, I'm not going to get into how the government should allocate that money because I think they currently do a terrible job of allocating that money. Well, there you go.
Pay your income tax and shit.
So Michael Chung asks, can you explain the process of a fire sale? No, I don't have a great grasp on a fire sale, but and I think you mean a power of sale. Because sometimes people say like a fire sale is like when people went through divorce. I've heard people use that term, like especially on Kijiji. People are like, oh, I'm having a fire sale, going through a divorce, or like I'm relocating to the U.S. Fire sale on my property. And they use that term. That could just like a fire sale can just mean like they're desperate to sell, right? They need to sell. Oh, my daughter wants me to finish up here. That's a good question. So should you churn girlfriends when they tap out of value? Brandon, I don't even know how to answer that. I gotta go here quick though. So power of sale is in the event of if they default on paying you interest. Yeah, I'm coming. I hear you the first time. Thanks for knocking again. That was a bit sassy of me. But, okay, so basically, if you don't pay the interest payments on your mortgage, the mortgage lender can go through the power of sale process, and they will take possession of your property, and they will force the sale of the property. A forced sale property will result in you losing control of your property, being evicted from your property most likely, and then they will sell your property. And they will not be worried about getting the maximum dollar for the property, which is a good opportunity for us to come in and say, hey, this is a power of sale opportunity where I can come in, it's a bank foreclosure or whatever else. There's a number of other reasons you can get one. Someone could die too. It could be power of sale because someone died. So an estate sale, you can have a bank foreclosure, power of sale. But basically getting the right to sell the property. And they're not usually concerned with getting the maximum price for the property. They're concerned with, can I get back my mortgage? Often the mortgage is significantly less than the value of the property. So if their mortgage is like half the value of the property, they'll just sell the property 80 cents on the dollar. They don't care because they just want to get their mortgage money back. They don't really care about the equity of the seller. There are a couple of situations where the bank has to worry about the equity of the seller, and at a certain point they don't have to. I'm not 100% clear on that. I would just Google it. When I get into a power of sale, I'll Google the process, and I'll get on the phone with the person and talk them through it. I don't have a clear understanding without doing a bit of research. I don't want to misspeak. But it can be an opportunity for a real estate investor. It's not a good thing if someone is foreclosing on your house and they're selling your house. You want to sell it before the bank takes over. So that's where the wholesale leads come in to my wholesalers, and they say, hey, we're about to lose this house. Can you pick it up before they get a chance to power of sale it on us? Have you heard of private lending of 75 or 80% loan to value of the ARV instead of just the current value? Yeah, so loan to value is how, like, the percentage of loan to value is up to the lender. Typically 75 to 80% is very normal. Yeah, so the value of the property, say $200,000, the 80% loan to value is a $160,000 mortgage on a $200,000 property. So they probably need to get a second mortgage or unsecured private lending to accomplish that, right? To get the remaining down payment. Or maybe the real estate investor has the money for the down payment and they put that up, and the private lender provides the rest of the funds in the form of a first mortgage. That's basically how it works. Yeah. Value is the difficult part. Appraisers disagree on what value is on a property and what is current value on the property. It's whatever someone's willing to pay. And so that's where sometimes I buy properties that are significantly undervalued, and the appraiser will just come in and say, what are you paying for the property? And they'll use purchase prices, they appraise value as like a cop-out. When the property is really worth like $300, they'll say, oh, well, you're buying it for $200, so the value is $200. And the bank only lend you 80% of $200. They should lend you 80% of market value. I've had deals, though, where I got 80% of market value, and it was more than the purchase price. And so I bought the property for negative money down. I got paid to buy the property. That's a cool situation to be in. A couple of my investors can chime in here. Jason, Taj, like a bunch of you guys can jump in and testify that we've done that on some properties where we've, after closing, got a mortgage on it that was way more than purchase price, and we walked with negative money in the deal. That's a great position to be in. Okay. Do you use purchase plus improvements mortgages? Yes. I've talked about that before at great length several times in the Mike Rosehart Show. I like the purchase plus improvements mortgage, especially if you're buying closer to market value. If you're buying a property that's roughly at market value, you can get a purchase plus improvements rebate for like $60,000 back after 120 days if you do the work. And maybe you only spend $30,000 to do the work, so you get a free 30 grand because you used overstated contractor invoices and quotes. So that's one way to do that. Can I get $100,000 passive income with less than $1 million, like $800,000 with a 12.5% return? Is it hard to do in real estate? Yes, you can do it. You can get a higher return. It's hard to count on that consistently. With $800,000, you could get $100,000 in passive income. Very possible to do. I wouldn't guarantee. I wouldn't bet the farm on it. But yeah, you could do it totally. Depending on how bad the investor needs the money. The more they need the money, the more they might be willing to pay. So yeah, it just depends on how desperate they are and what they're willing to pay you. If you're actually buying properties, yeah, with leverage, you take $1 million, you buy $5 million in real estate because you borrowed $4 million in debt, mortgages on the properties. Then yeah, a $5 million real estate portfolio will make way more than $1 million, unless it's in like Vancouver, because you got like 2 houses in Vancouver for that price. Okay, people are asking for email. Should you churn girlfriends when you tap the value? Oh, we did that joke already. Mike, isn't private lending risky? I mean, bankruptcy is a thing. Yeah, so Future Wiz, it is theoretically risky. Private lending, though, can be first and second secured mortgages. So in which case, if they declare bankruptcy, you just take the house and you sell the house to recuperate your money. I think that, in honest, if people are lending me money, they're safer getting a personal guarantee from me than getting a guarantee of first secured on a property. It's more likely the property will go bad than I will run out of money. I got millions, and I'm so frugal, I guarantee I will never lose. I will never not be a millionaire the rest of my life. That is a guarantee. In fact, I keep $1 million safe outside of it. I don't bet that. So yeah, I think that in the right situation, you don't have near as much risk. You can mitigate your risk substantially investing with the right, lending to the right people, the right person. So you can lend to me, pretty safe. Hey Mike, when you report your private lending, do you report it under other sources of income or just regular income? Yeah, under other income is a place that I report my private lending. I don't do a ton of it, but I should start getting into it. I want to get into it. My end game is eventually, like when I have like 10 or 20 million in wealth, just invest that like 10 or 15, just 10%, let's say. That's like a couple $1 million a year in passive income. That'll be eventually what I'll do. I'll start a corp to do it probably because I want the write-offs associated with that. So I'll set up a lending corp most likely, and I'll like, you know, go on trips to talk with borrowers about, you know, stuff, projects they're working on, and then it's write-off. So you know, go on trips for fun, and I can write off a lot of stuff against that just to make it a business expense. So that's the end game. Okay. Capital gains tax at 15% in the U.S. Multimillionaires and billionaires living off investments pay less tax percentage-wise than a working man. That's probably true. I don't know in the U.S., but yeah, it feels like in Canada it's half inclusion. So capital gains are half taxed, half of your marginal tax bracket. So if you make $100,000 capital gain, $50,000 of it is taxable, $50,000 of it is tax-free. So half of all capital gains are tax-free right off the bat, even if it's not your primary residence. And then that half is taxed to your marginal tax bracket. So if you make $100,000 capital gain and you're at the max tax bracket, you're going to pay like 25% tax on that capital gain in Canada. Is what it is. It's better than regular earned income. So dividends and capital gains, best kind of income to earn. At Mike Tribute Money, why not just shoot them when they riot? Whoa, that's it's too dark for me to get on. I'm gonna get demonetized for talking about that kind of stuff. But I think with the advancement of artificial intelligence and like AI and robotics, we may eventually get to that point, unfortunately, where the ultra wealthy will have like an army of like turrets around their mansion, and if you just come and try to steal from them, they'll just shoot you dead. You know, because if you're trespassing, then you have the right to protect yourself, and so the AI will just kill the people who try to revolt. Currently, it's very hard to do that.
In the U.S., you have the right to defend yourself.
Yeah, there you go.
In Canada, you don't.
You don't, eh?
No.
So maybe we should work on lobbying to ensure that we have the right to protect ourselves.
Someone I know was once told by a cop that if someone comes on your property and steals stuff, make sure if they're running away, shoot them and make sure they're dead. because they can turn around and sue you.
Yeah, I have heard that.
If you've heard that.
I heard the guy who fell through the storm, like the
Yep.
skylight, and landed on a knife in the kitchen and sued them, and won.
Yeah.
And I was like, really?
Yeah.
You broke into their house and you got hurt and you sued them?
Make sure he's dead.
That's crazy. I don't know how true that is now. I'm sure they've fixed that loophole, but maybe it still exists. I don't know.
I think it still exists. It's pretty brutal.
Good answer on taxes. We do need to help less fortunate. I have
As a side note, I'm not advocating for murder.
Yeah. Can we not say that on the air? Ilya says, is buying land worth it close to the beach? Ilya, I think that it depends. It's my answer for most things. It depends on the situation. I don't like land development because it doesn't cash flow. So you're speculating, which is taking a bit of risk. And being a developer is very, very difficult. You need to have deep pockets and take a lot of risk. Trust me, I'm doing a small subdivision right now, and it's a pain. I'm never going to do another development for a long time. Okay. Mike, don't let yo girl bitch at you. You're the man. You go when you feel like it. Keep yo pan strong, my dude. Your Muslim tenants would not tolerate that from their women. This is true. They wouldn't. Yeah. No comment on that at all. I have an open, respecting relationship. She's right. She knows that I try to make bath time and bedtime a priority in my life, and it is a priority for me. And so with that, it is 8:42, and I didn't realize it was that time. I'm going to go and focus on family time. Thank you all so much for the last hour and 40 minutes of your time and watching my show. Shoobs just joined in and said, hey, Mike, just stop in. Good to see you on. Hopefully some of this ends up on the main channel. There was some really good content tonight. It's the first time in a while that I felt like we got really deep and added some good value. So really excited about that. I think we got a video, at least one video, maybe two, out of this Wise Wealth show. So thank you all for tuning in and watching. It means a lot to me. If you do one thing for me, you can hit that subscribe, hit that like on this, and share this around, because no one's on the Mike Rosehart Show YouTube channel. So no one's tuning in to the Wise Wealth Show. We're getting, probably no one's even watching right now. There's 17 people watching. That's not bad. But it would be great to have 30 and 40 and 50. We had 56 one time, I think, or 55. And that was because the main channel had more subscribers. So it's up to you guys to share it around and ensure that we get more subscribers and build it out. If you guys keep demanding it, I'll keep giving it. No one watches, no one cares, then the Wise Wealth Show may cease to exist, or the Mike Rosehart Show may cease to exist. The show will go on. I'll still be on Instagram, YouTube, and Facebook, and everywhere else you'll find me. But if there is no demand, and we answer all the questions 1,000 times, at a certain point, the show doesn't need to exist. But for now, it feels like it does, and I think people are getting a lot of value. And I thank you all so much for tuning in. Isn't this cute? It's got a little microphone. This is not even got the lav plugged in. It's just the speaker. Isn't this so cute? Just clip it on, put it in my pocket. This is the best. I love this little thing. Need to get more of these and place them everywhere. Anyway, bye guys. Spend less, earn more, and maximize your returns. That's the secret to unlocking wealth. Bye. You guys want to flex? Okay. Bye guys.